Good morning, everyone. My computer says it's 9 o'clock. We have a lot to cover today, 56 slides worth. That's because I'm doing the weekly data plus the monthly data. I'm going to spend most of the time on the weekly data and then go over the monthly data rapidly and let you review that offline or on YouTube after the meeting is over with. We do the monthly data on the second Saturday of every month. Otherwise, the rest of the Saturdays, we just do weekly data. This slide tells you how to access different things. Basically here on May the 9th, if you want to get a copy of today's slides, here's the URL. I use tinyurl.com, RE for real estate market, graphs, plural. That's the root of everything I do in this meeting. And if you want the handout, it's handout singular and then the date code, which is the year 2020, month 05, and then 09. To get to the archives on YouTube, you just drop off the date in the handout. So it just be tinyurl.com/RE market graphs. And if you want to attend this meeting and don't want to remember the password embedded URL, which is in the blue right here, you can do RE market graphs and the date code and get to the meeting. Having said that, let's dive right into it. There's basically three types of data. One is macro data, which is where I'm looking at condos, townhouses, Santa Clara County and San Mateo County all lumped together. I'm just trying to figure out what the real estate market globally is doing. Is it improving? Is it getting worse? Versus the degree of which it's doing that. Then we have the micro market, which is where you're interested in a particular area and you want to know specifically how that area is performing. And then the third data is the monthly data, which focuses on single family homes in Santa Clara County, countywide, but it goes back 20 years. So it gives you a nice historical perspective, because in the long term, all boats go up and down with the tide, but in the short term, there is definitely differences between the different micro markets. In all the data, there's two key points, in my opinion, and some people might say there's three, but boils down to two. One has a subset. The first one is days of unsold inventory, and basically that's supply-demand ratio, which in a pre-capitalist society, that drives what future prices are going to do. The higher DUI is, the longer it takes to sell your existing inventory, the less price pressure there are. The lower the DUI, the faster the market's going, the more price increase pressure there is. The second indicator that has the two phases is overbidding. There's the frequency of overbidding, how often consumers are overpaying more than the seller's asking price. And then the second component of that is the magnitude of overbidding. How much are they going over the asking price? Here is the macro data that I was talking about. So this is trying to find out what is happening with just shelter in place. Now, I've only been following this data since shelter in place, so I don't have a lot of track record with it, but I am fairly comfortable with it. The vertical purple line is when SIP, shelter in place, was announced. The data line is the blue line right here that moves around quite a bit. This particular thing is total available inventory. My definition of available inventory is it's on the market, it's active, and there's no contracts of any kind on that property. So the first buyer in with a good offer, the seller could theoretically sign it. A lot of people include contingent offers where there's already a contract, and in order for a new buyer to come in and buy that property, they have to get rid of the first buyer. Very few buyers are participating in that. Because very few buyers participate in that, I don't really consider that inventory. Additionally, at the beginning part of the year, when there's basically been no sales over the holidays, you have a large increase in pending transactions, contingent transactions. So a lot of people will show their inventory going up when available listings with no underlying contract is actually going down. So in my opinion, you actually get wrong indicators based on using anything than totally available properties. So that's my definition. That's what these slides will be using consistently throughout. The gold line here is in this particular slide, it's the 4-year median of available inventory. For the slides after this one, it's going to be the 5-year median. So you have some concept of what's happening, because real estate has a huge weekly cycle and a huge annual cycle. So this golden line basically takes out the annual cycle and says what's happening. So you can see historically, when you start at the beginning of the year, up it comes, and inventory is normally increasing as we go into the years. Now, the reason it drops down here is I just haven't plotted those data points out yet, and I will be doing that as we get closer to that those points. The red line is the ratio between the data point, the blue line, and the benchmark, the 4-year median in this case. So right now, if you look at it, you can see the red line has been basically right about 100%, which means the inventory right now is 100% of what it typically is. Now we're going to be looking at the number of new listings. These are the number of listings that have come on the market during the past week. So normally at the beginning part of the year, you're up around 500. Then you can see normally in a normal year, based on now the 5-year median, we'd normally be up somewhere around 600. Basically here, because of shelter in place, we're down around 250. Now there's been a marked increase, which is the reason following this data is important on a weekly basis, because this last week, almost 2 weeks ago now, but only 1 weekend of showing activity, and those activity would have resulted in offers this past week, and that is that we can show all homes as long as the sellers are out of the property at the time of the showing. And you can see we went from about 250 sales a week to 400. So at 400, we're now basically somewhere around 2/3 of normal instead of somewhere around 1/3 of normal, or maybe a little bit more than 1/3 of normal. So that was a huge improvement. There's no way to predict what the future is, although I would expect this line to continue to come up, and I would expect we'll get pretty close to the 5-year median. I don't expect to reach it exactly. You'll notice there's some huge dip down. When we look at those, we'll probably find out that those associated with holidays, because every holiday negatively impacts real estate except for 2, Mother's Day and Valentine's Day, which both have a slight positive impact. The other side of the equation for days of unsold inventory is the number of offers that have been accepted in the past period of time. I normally use 5 weeks. Again, this is macro data, not the micro data. So here I'm looking at across all types of property in the 2 counties that basically make up Silicon Valley, how many offers have been accepted. A lot of people look at pending transactions. That, in my opinion, is not as accurate and not as useful as the number of offers accepted. The reason for that is duration of escrow changes. As escrows take longer, your pending transactions go up. At the beginning part of the year, there's been very little activity over the holidays, and so your pending sales are going up. At the same time, your number of sales could be going in either direction. So it's important to, in my opinion, to look at the fundamental things, not conglomerates. Anyway, back to the purple line being the vertical. This is where shelter in place occurred. The blue line is the raw data. The golden line is the 5-year median, and the red line is the percent of normal. So you can basically see the beginning part of the year, we were right here at about 100% of normal. And then all of a sudden we dropped down to 80% of normal. I believe that some of that may have been transactions that occurred that fell apart with the announcement of shelter in place. Shelter in place was announced, and boom, we went all the way down to about 35% of normal. Then we hit 40% of normal. That was probably when we could show vacant properties that were no longer occupied. Now we're basically hitting 55% because we can now show occupied properties as long as they're not occupied at the time of the showing. I expect that this will start going up a little bit more, maybe 65%, maybe 2/3 of normal, because I think buyers are ready to return to the marketplace and there's enough sellers out there. Anyway, so this is the number of new offers accepted in the past week only in San Mateo, Santa Clara County, single-family condo and townhouses all combined to get a macro look at things. Moving on to the third component, which is close of escrows, which are now delayed, and you can see that we're basically somewhere right around 100%. We dropped down a little bit more slowly. We got down to around 60%. Then we plummeted now to 40% because there's about close to a 4 or 5 week delay. So if you come back and say that shelter in place happened in the 10th week, you come out here to the 15th week, and that's when you're dropping down. It got extended a little bit because problems developed and it took longer than normal to sell it. The same concept, the red line is the percentage, which is the ratio between the blue and the gold, and you can see the blue and the gold here are on top of one another, which is when you're basically at 100%. Then all of a sudden shelter in place basically occurred. The blue line went down, the gold line continued the normal trend. You can see we're soon reaching sort of the plateau of when the most closings happened. Now we're looking at the knee-jerk reaction of the sellers that were on the market when shelter in place was announced. This is the number of new cancellations. And you can see that we were running again right around 120%, a little bit more than normal for whatever reason, but it fluctuated a lot, down to 100%, up to 140, with an average of 120. You can see the data here. The blue for this entire year has been above the gold. Just an interesting observation. Shelter in place was announced, and you went from somewhere around 25, 35 cancellations a week all the way up to 160. So doing a little quick math, what is that, 5 times the number of cancellations, but it was very short-lived, and basically by week 14, so after just 4 weeks, we were back down to the normal level again. And I guess it was only 3 weeks of elevated because you had a data point here, one data point here, so that's week 1, week 2, week 3, week 4, we were back to normal. Number of withdrawals, the first thing you may notice is the gold line and the red line are not here. And there's a reason for that. And that reason is the MLS considers a withdrawn listing to become an expired listing when the expiration date happens. So there's no way to go back and find out how many listings were withdrawn from the marketplace, because most listings are less than a year in duration. So a year ago, all the listings that were withdrawn are now showing as expired listings, and without looking at every single listing that expired and seeing if it withdrew first, there's no way to get the data. But you can see the same trend happen with cancellations. You started off with very few withdrawn listings, somewhere down around 5. Then we shot up to around 70 for one day, 1 week, and then we were down around 30. And this week we dropped to about 25. Basically, I think sellers' expectations when they put their house on the market was extremely strong. We were going into the best time of the year, and then they got sideswiped by shelter in place. This is new data. It's very interesting data. There's only one data point, and that's why it's in a table instead of a graph. We're going to try to explain this to you, and it's a little convoluted. We're going to start at the bottom of the 2 items. And basically what I'm trying to do is figure out what the market's doing. And if I go back to April 4th, I come forward to 35 days, we're basically at today. So that's what I've done. And I said, well, in order to know anything about what's happening on the sale price, it has to be a sale offered during that period of time and a closing in that period of time. So it's going to be a quick close, which is going to skew the data. So to mirror that, I went back in time and said, what period of time is the best mirror close in time? And unfortunately, there's only 1 week to mirror it with, and that happens to be the week that started right after Super Bowl Sunday, which would tend to have had a little pent-up demand, but February the 8th for the next 35 days, because that ends on March the 13th, the Friday before shelter in place was announced. And in this case, I only use single-family homes because the data set is pretty small in number, and I only used it for home in geographical areas that were similarly priced, which would be Blossom Valley, Evergreen, North Valley, Milpitas, Santa Clara, Willow Glen, Cambrian, and Campbell. And then you look at the different metrics. So we number our different areas, and you can see the median and average for both of them are essentially identical, which would tend to say my data set is fairly good. The bedrooms is 4, and then it's 3. So you go, wow, that's a big difference. But then if you look at the average, it's 3.5 and it's 3.499. So there's very little difference on the average. The problem with the median is you use a data set. So this could be the highest 3 and that could be the lowest 4, and there'd be essentially no difference whatsoever. The number of bathrooms agrees fairly nicely. The square footage, the current stuff is about 100 square feet smaller, which is somewhat significant. But the average is actually a little bit higher as well, but not as much, only 50 square feet. The year built is roughly the same, and the lot sizes are roughly the same. So those are all good indicators that my data set, even though it's extremely small, is somewhat well behaved. Then you look at days on market. as offered by the MLS, and you go, wow, there's a huge difference from 7 days to 0 days, 14 days to 4 days. The reason for that is the MLS froze days on market because of shelter in place. So now I turned around and calculated it. So I looked at the list date and the sale date to calculate the number of days on the market. And it agrees fairly well for the same data point. The MLS reported 7, I'm reporting 8. And I think that's because they report day 0, and I think I counted as day 1. There's close agreement, 7 and 8, again, you don't know if this is 7.49 and this is 7.51. The averages are pretty close together, 0.3 of a day apart. And then you come down here and you go, here's a difference, 4 to 12, and that's because we stopped counting. 0 to 1. 1. How are we selling homes with just 1 day on the marketplace? And apparently from looking at the raw data, it appears that a lot of transactions are just happening without being on the MLS, since we can't really show them anyway. And then once they get into contract, they're putting it on the MLS. So a larger than normal percentage of properties are coming on the market with a list date, sale date, and close of escrow date all the same, and you get this 1 day on the marketplace. Now you look at list price, we went from 1.2 to 1.3. The average went from 1.3 to almost 1.4. It's only 75,000 increase, but that's pretty significant. You look at the sale price, we went from 1.350 and 1.4 to 1.3 and 1.4. So there's, again, looks pretty well behaved. Then you come over to the sale price to list price ratio, and you basically went from 108% back in the February, early March timeframe to 100%. And you go, wow, what's going on? Well, you look at the next data point, and basically in the first data set from the weekend after Super Bowl until the week before shelter in place, only 16% of the sellers got under their asking price. 77% of the sellers were getting over their asking price. Now, 22% are getting under, which isn't that much dramatically different, but the big change is only 41% are getting over. So what I read into all this data, and what I believe is probably really happening, is the buyers that are out there looking aren't sensing that they have to outbid the seller's asking price in order to get the property. So they're basically going in and matching the list price. So this is the marketplace where the sellers and the listing agents have to be careful to price the house at the real market, not the concept that we would have been using in February of, oh, price a little bit low, the buyers will come in, the multiple buyers will drive the price back up. With only 41% getting over, that's not happening, versus 77. Big drop there. And from 108% of asking to maybe 101% if you average the median and the average. But at 100% for the median, that means half the people are getting less than their asking price and half are getting more, putting the median right over. The average is 1.2, 102%, and that's because one person getting 110 brings up a lot at 100%. Now we'll go back to sort of the micro market data, and this is looking at the overbid, which requires sale price. So this requires closes of escrow. So there's a 30-day delay. This is current. You'll actually see the red area covers most of Santa Clara County. The exceptions would be South County being gray, which is balanced, Saratoga and Los Gatos being gray or balanced, and Los Altos, Palo Alto being gray or balanced. In San Mateo County, it's noteworthy that your Menlo Park, Atherton is a nice coal marketplace, so blue. Most of the geography, or half of it, is gray, but the Bay City area is red, which is red hot. And then we move just last week, and you'll see the difference. Saratoga and Los Gatos were both red. Redwood City went from gray to red. The coast stayed the same, and some of the Bay cities went from red to actually blue. And that's so back to the current week. So you can see it's solid red up there, solid red for most of Santa Clara County. This again is back to the May 9th data, today's data. Changing gears to days of unsold inventory. This to me is probably the leading indicator because it's looking at the number of offers accepted right now. You don't have the 30-day delay. And this is going back in time. And it's going back to April 11th. And then we're going to come forward week by week. That was a dramatic change. I'll go back just so you look how much red there is in Santa Clara County. All this area is red. The San Mateo County is red. Now a lot of San Mateo County is blue. A lot of it is gray. A lot of the East San Jose and South San Jose and Saratoga Los Gatos are gray. So pretty dramatic change in 1 week. A little bit more of a change to a more balanced market. Basically, red has disappeared everywhere except for Foster City. The slow, cool area expanded into Los Altos, Palo Alto. But now we're going to change in reverse direction, which may sound weird, but this corresponds with allowing us to show properties that were no longer occupied, vacant properties. So now you got the affordable areas coming in at red. You got Cupertino, Sunnyvale, Mountain View coming in at red. You got the Bay Cities coming in red. And with the warmer weather on the coast is coming in red. So that's a pretty dramatic change during shelter in place. And that was basically caused by the ability to simply show vacant properties. 1 week later, and it's just statistical fluctuation, we're back to a little bit of gray. But the areas that changed from last week, which is now on the screen again, to this week, which is basically the San Mateo County, Bay City area and the affordable areas of Santa Clara are the two that changed. They were on the cusp of the change between a hot marketplace and a balanced marketplace. So the data hasn't changed much, even though the color, it's either on or it's off. So it went over the threshold, so it got changed, even though the data didn't change very much. Now we're looking at the actual raw data. So we're looking at days of unsold inventory. Unlike most data points, as days of unsold inventory go up, the market's actually slowing down. This is telling you it takes longer to sell the existing inventory. So you can see we started off the year at a pretty low number. I consider anything below 40, which is this horizontal gray line right here, to be a strong seller's market. Anything above 80 to be a strong buyer's market. In between 40 and 80 to be a balanced market. So we were down here somewhere around 30, 35. Shelter in place happened, and then fairly quickly we started to climb. We didn't climb that high, but we got up somewhere around 65, maybe 70. And now with the ability to show properties again, this is dropping down. Also notice there's some horizontal lines. I do that intentionally. I use 5-week data points, which ends, one data point to the left of where it's horizontal. That would be the May 9th data. You can see it's back here somewhere. And then I look at the same data set, but I only look at 3 weeks, which is the first horizontal thing. And then the second horizontal step is only 1 week worth of data. So 1 week of data is pretty fluctuating, but what it does, it gives you a trend. It gives you an idea that the downward trend of DUI is most likely to continue next week. So you start anticipating a leading indicator. It's dangerous because sometimes, something like shelter in place happens and it turns around and changes direction. But barring something like that or a 9/11 that we've had in the past, I would expect next week that the DUIs will be lower than they are this week. This is all the 22 areas. You can pick your favorite color from the index up here and try to spot it as we go from slide to slide, because the colors are assigned by Excel, so they should be the same between all the slides that are coming up. Now we're talking about available data, available listings, and again, I use available. That means no contract of any kind. I do not count contingent offers and things like that many people do. The vertical line, the purple vertical line again, is shelter in place announcement. And you can see the available listings decreased in all 3 areas that I'm following. And these are the 2 counties, Santa Clara County, San Mateo County, single family. The condo line appears to be Santa Clara County only. And I think that's probably accurate because this is done automatically. And I combine them for the macro data, but I don't combine them for the micro data, which is a little confusing even for myself that works with the data all the time. So here's all the different micro market areas, again, with the inventory. Because the county data is so large compared to the individual micro market areas, they stand out as having more listings. And again, you can see it's a little harder to tell, but there's a flat spot here. Now, this is flat for 6 days. And the reason it's flat for 6 days is inventory that's available is an instantaneous. It's not inventory over the past 5 weeks. It's inventory on a given day. So if I look at inventory 5 weeks ago, it's going to be the same as inventory 3 weeks ago and the same as inventory now, because it's the span of sales and the span of closings that's changing. Inventory is basically taken at 12:01 a.m. this morning. So it's a set point in time, so there's no way to get it any more current than that. Here is the number of offers that accepted over the past 5 weeks. And again, I use offers accepted. The offer counts even after the escrow has closed, where a lot of people will count pending transactions. So if you have a 3-week escrow, that will only be counted as a pending escrow, pending transaction for 3 weeks. If you have a 7-week escrow, that counts for 7. By looking at the offer date and only counting for 5 weeks, every offer counts the same, which I believe is a lot more statistically significant than having it depend on how quickly you close escrow. In my data, if a transaction falls apart, it no longer counts. It disappears, just like with people that count pending transactions. So you can see the pending transactions were going up in all 3 graphs. Shelter in place, the vertical purple line was announced, and boom, they all started coming down. So the buyers basically disappeared. And they didn't completely disappear. You know, you were basically at 1,000 for Santa Clara County single family homes, and you came down to basically 500. So we lost 50% of the buyers. But now what you have to remember is this trend was continuing to go up. So it probably would be up around 12 or 1,300. So now you really have about a third, a little bit more, maybe 40%, probably more accurately, of the number of offers accepted. Here's the number of offers for all the different micro market areas. Now we're moving closed transactions. Closed transactions, you have the duration of escrow, which is roughly about 30 days now. And that's why shelter in place was announced, and actually closed escrows continued to go up for a while, then they leveled off. And then finally they're starting to trail down now because the number of closings, the number of offers went down, and now that's resulting in lower close of sales. Now here is the same data, and it looks pretty strange, and it caught me off guard, and I looked at my analysis, and I believe my analysis is correct. I think what happened here is I'm using the end of the month data, and so the end of the month tends to have more transactions. So even though this is really only 3 weeks, and so if I divide it by 21, it's really closer to 4 weeks because more transactions are closed the last week of a given month. And then similarly, the first week of the month tends to have very few closings, and that's why data based on 1 week, which is from May the 2nd through May the 8th at 11:59 p.m. is lower, is because very few transactions close at the beginning of the month. So this is a statistical fluctuation that tends not to show up when you use a 5-week moving number like I typically do. And that's one of the drawbacks of changing your data collection mechanism. But I felt it was important to try to get a better, more accurate reading. And that's why I did the horizontal data points in a row there to make them really stand out so people would know it's something unusual. Here's all the different micro market areas, and you can see every single micro market area is doing the same thing. So I either did a global data error collection, or it's something to do with the calendar. And I looked because it caught me off guard initially, but I couldn't find it. So I believe that's simply a calendar effect. Now we're looking at frequency of overbidding. Since we're looking at overbidding, we need to know the sales price. To have the sale price, we have to have the close of escrow. So we have the same pattern as the previous slides, where things stayed level for quite a while past shelter in place, and only recently have they dropped down. This drop down, I think, is real. So now that we're basically closed all the properties that were negotiated prior to the announcement of shelter in place, we're seeing the frequency of overbidding dropping down fairly significantly. And I expect with the level for 3 weeks and the level for 1 week to be lower, I expect the data point for next week for the 5-week to continue to come down. Here's all the different micro market areas. You can see that for the most part they've stepped down, but there are a few notable exceptions where they actually have stepped up. But that's also the issue of when you're only looking at 1 week, your data is a lot more susceptible to statistical fluctuations that mean nothing. Here is the second component of overbidding called the magnitude of overbidding. How much do the buyers feel pressured to overbid? And you can see the same pattern. They were level for quite a while after shelter in place because of the 30-day lag. Once we started working through the offers before shelter in place, the trend was coming down. So buyers were paying less and less over the seller's asking price. That pattern follows across all the different micro market areas. Now we move on to sale price, and instead of following just the median sale price, I follow the 10 percentile, the 50 percentile, which is the median price, as well as the 90 percentile. The huge advantage of doing that is you sandwich the price range in each of your micro market areas. I can confidently tell a consumer that 80% of the homes in any micro market are between the 10 percentile number and the 90 percentile number. And you can basically see the prices were down, prices were coming up. They continued to come up after shelter in place was announced. They were flat as we ran through the 30-day escrow duration, and then they've trailed down ever so slightly. The same pattern for all the different micro market areas. It looks more flat. Some areas were more significant. I believe this is going to be Los Altos, Palo Alto, and this is going to be Menlo Park, Atherton, I believe, and the two are absolutely going in opposite trend directions, which is a little unusual, but interesting in itself. They started off the beginning part of the year very similarly. They're ending up right now, recently, very similarly, but right about the time that shelter in place was announced, they were off. And I think this is just the statistical fluctuation, because when you're talking expensive homes in Los Altos, Palo Alto, and also a second micro market of Atherton and Menlo Park, there just isn't that many data points. Moving on to the median sale price, which is going to be a whole lot more stable. As you can see, the lines are just a lot smoother. You can start seeing the median price for Santa Clara County started off the year somewhere around $1.2 million, dipped down. Then it came up to 1.4 million, basically was level, and now it's starting to dip down ever so slightly. But now that we're able to show occupied houses, it looks like we may go up. All three of them look like they're going in the upward direction, but the upward tick is only for when I'm using 1 week data. So 1/5 my normal data, so a lot more data fluctuation. Here is the 22 micro market areas. The trend looks fairly flat, but it's probably very similar. Moving on to the 90 percentile number, we're getting a little bit more statistical fluctuation again, since you're looking at the top 10%. And because we're looking at the higher end prices, the fluctuation is a little bit more than the bottom 10, even though they're both 10% of the marketplace. The bottom 10, is a lower number, so it doesn't fluctuate as much as the upper end. You can see the trend has been basically, peak was right about shelter in place, a little bit after, and then it's been flat and going down. It's somewhat interesting that San Mateo, Santa Clara County are very close together now. They were very close together at the beginning part of the year, but they spent a fair amount of the year diverging and not being very close. I mean, you can sit here and have $100 million difference. Right here, you're $2.5 million for Santa Clara County and $3.5 million for Santa Clara. You come back a little bit, and it's hard for me to pick numbers, but I could pick 2.6 and 2.9. So you only have a $300,000 separation. You come out here and it's actually labeled, because this would have been the same data point. There's only a $225,000 differential. If you come to this point, there's a 500,000, $700,000, probably $1 million difference between them. So that gives you an idea of how much fluctuation there is on the top percentile, which is why you can't read a market based on a 90 percentile, but it does tell you what the more expensive homes are. And here is, again, all the different micro market areas. Moving on to duration of escrow, you can see we're basically at pretty quick time. San Mateo County was down here at 25. Santa Clara County was basically at 27. Shelter in place was announced. Complications arose, delays happened, and all of a sudden, boom, we're back up at 30. 30 days is still not a bad length for an escrow. When I got in the business back in 81, it was pretty common to write a 45-day close of escrow contract. Here's the duration for all the different micro market areas. You know, it's hard to pick out any one given area, but you can clearly see the number was down here somewhere now, and that by down here somewhere, probably somewhere right around 27 if I did a quick average. Now you're up here somewhere around 30, some areas at 32, some areas up at 34, but some areas still coming in down here around 28. You got a few outliers, and these are probably very small micro market areas that are able to still close them in like 22 and 24 days. Median days on market, pretty meaningless data. Shelter in place was announced. I don't know when the MLS froze the data, probably right about here. And maybe it took them longer to actually implement it, but here it's, you know, just ratcheting down. So I would say actual implementation probably occurred here. They're at 0. This is actually somewhat of an interesting data in the fact that that says that 50% of the homes or more of what is actually getting into escrow is getting into escrow for properties that were listed while shelter in place was in effect. Here's all the different micro market areas. You can see pretty much every one is at 0. There's 3 exceptions. One looks like it's at 1 day, one at 2 days, and one at 4 days. So all very low, but again, that's because shelter in place froze the days on market according to the MLS. Here is actually the table, a little bit more readable than in past weeks. This is where you can look at any given metric for the different micro markets. So this is single family homes in Santa Clara County, my different micro markets. Then you move on to San Mateo County with the little definitions at the bottom of the page since there was room. And then we move on to condos and townhouses for both Santa Clara and San Mateo counties. Then since we're focused on COVID-19, I haven't updated the graph, but we flattened the curve and we're not doubling now, probably somewhere around 45. I think I actually said read 60 days. So the market's really flat, but I think a data point that I think is more meaningful that just came out on Friday that was effective as of Thursday. Out of 111 current hospitalizations, 51 were out of the general population and 60 were out of facilities. In my opinion, that's significant because what's going on in facilities doesn't require shelter in place for the general population. Just the same basic slide that we started the meeting with. If you have any comments, questions, how I can make it better, please send me an email. And with that, we'll go right into the monthly data. The monthly data starts off with the 10 and 90 percentile for single family homes in Santa Clara County. It's on semi-log paper. That's significant because now the straight line slope through this would be the compound rate of appreciation for the different areas. Here is the same information, sale price, but on regular graph that you're more likely to have seen historically. My horizontal lines need to be adjusted. They were meant to be at the peak historical pricing, so somehow I must have moved the graph relative to my lines. Here is the last 10 years. So the pattern going forward is the first slide. There'll be a pair of 2 slides. The first slide goes back 20 years. The second slide goes back only 10. I'll spend most of my time on the second slide going forward. So here's the 20-year cycle of data, and here is the 10-year. It's supposed to be the 10-year. There are 2 20-year cycles. I'll fix that for next month or next week. So we'll pretend that the scale isn't compressed. Basically, we have 2 sets of data on one graph. At the top part, we have the magnitude of overbidding. How much is the seller paying above asking price? And right now, the buyer's paying 103% of the seller's asking price. Now, remember that number earlier was lower. It's a different set of data. This is single family homes, Santa Clara County, and this is for the data set that started on April the 1st and then came forward for 35 days. Basically, between the blue and the red line is what I call a balanced market. When the data point, which is the darker blue line, goes below the light blue line, then you're in an ice cold market. When it's above the red line, like it is most of the time and currently still is, that's considered a red hot marketplace. The second set of data is the frequency of overbidding. How many buyers are overpaying trying to get a house? And right now it's at 66%. You can see last year it peaked out at something like 80%. Even recently here, this looks like it probably would have been up at 75% of the buyers overpaying. Again, same argument. If it's above the red horizontal line, it's a red hot seller's marketplace. Between the red line and the blue line, it's a balanced marketplace. And below the blue marketplace, it's an ice cold. And this is the graphs that, this one chart, I use both of the data inputs to determine the graph color of my zip code maps that we start off with. This came from a suggestion to have a graph that's sort of like the advanced decline ratio of the stock market. And after having called it that for a while, it occurred to me that a better name, and I haven't successfully transferred everything, is the over-under bid ratio. So if 40% of the sellers are getting more than their asking price and 40% are getting under, the ratio is 1, and that's showing up on the gold line. So right here, the gold line is about 2.5, and you can see that the purple line is right about 65%. If you take 65% and divide it by 2.5, you would get the number of underbids. At the risk of doing my math quickly, it's somewhere around 20. So that'd be 40, 25, closer to 25. So somewhere around 65% of the sellers are getting above their asking price, 25% are getting under, and that leaves 10% getting their asking price. And where it stands out is here, as the number of sellers increases to all of them getting the gold line, the ratio between the overbidding and underbidding skyrockets. So it really catches your attention, and that's sort of the purpose of it. I may advance this with a little bit more homework to closer to the advanced decline ratio, where I take into consideration the volume of transactions in a given month, because right now, each month, it weighs the same, but in January and February, and there's going to be less closings, that would be less significant than an April, May closing month when there's more transactions. Here is the 10-year that I didn't advance to because I got goofed up on the previous slide. Now we move to days of unsold inventory. And this is probably the best leading indicator because you don't need to wait for escrows to close to find out what's happening with the overbid ratio. You simply look at the number of offers being accepted to the existing inventory. And the data point is the dark blue line. And again, if it's below the red, it's a red hot seller's market. If it's between the red and the blue, it's a balanced market. And above the blue, it's a buyer's ice cold market. So right now we're at 62.1, which, really is not that bad. When you say it would take 2 months to sell every single property on the market, if the rate of sales stayed constant and no new listings came on the market, that's not bad. We're pretty blessed typically in the Silicon Valley with a very strong marketplace. And again, this is going back for 20 years. Here's the same data place going back for 10 years. So in the last 10 years, you can see the bulk of the time, in the last 8 years have all been in a seller's marketplace. The 10th and 9th year back, we're sort of in a balanced marketplace. It's also interesting, we typically spend, and you see it better here, we typically spend very little time in a balanced marketplace other than when we're passing through, where we tend to be stable in a seller's marketplace. Not what I would expect, but what I find time after time. This is interesting in the fact that I take all the major components and I look at the 12-month moving value. So what is the inventory for the last 12 months divided by 12? What is the number of offers accepted for the last 12 months divided by 12? What's the number of closings? What's the sale price? And so it's basically the average. The only one that doesn't follow that is the purple line, which is the days of unsold inventory, the leading indicator. So it's there in real time to show you what happens if you're looking at the data. The blue line is inventory. The reason I picked the ice cold is as you get more and more inventory, the market tends to cool. So more blue cools the market. Offers is red, because the more offers there are, the hotter the market gets. Gold is the closing of escrows. Green is the sale price, and then the purple is DUI. So basically, you start watching it, and here's DUI dropping, and then all of a sudden prices dropped and sale prices started going up. DUI is going up a little bit while later, the sale prices started to come down. So again, DUI is what I call a leading indicator. It's sort of a predictor of what's going to happen to pricing. The reason it's a predictor is, one, the duration of escrow. You don't know the sale price until that 30-day duration's over. And also it takes time for the consumers to go from, my God, there's a shortage of inventory, to there's plenty of inventory. So it takes a while for them to adjust. Here's the same data for the last 10 years instead of the 20 years. And again, we're now at the end in the same slide, so I'll just do a little bit of recap. You can capture the screen to get a handout, or you can use this tinyurl.com/RE market graphs handout 2020-05-09 and get this week's handout. You can advance that for future weeks after the presentation because the graphs are not there. If you want to get an archive of this and all the previous videos on YouTube, you just use tinyurl.com/RE market graphs. If you want future presentations, tinyurl.com/RE market graphs, and that future date, the next meeting would be 2020-05-16. All previous URLs are no longer going to work because Zoom changed and we are now requiring a password. Again, I'd love comments, questions, suggestions, feedback, issues, concerns, the whole enchilada. And of course, you can reach me at creeksiderealty@gmail.com. And in closing, I'm Richard Calhoun. I'm a broker realtor with Creekside Realty. My phone number is 408-926-0365, and I've been serving the Silicon Valley since 1981. Thank you, everybody. Have a great weekend, and happy Mother's Day tomorrow for those moms out there.